In this video, we're going to talk about how frequently you should trade. Let's jump into it. Alright, so how frequently you want to trade, it really depends on how much capital you have and how much time you actually want to dedicate to this. So just for easy numbers, let's say you have a $100,000 portfolio. And let's say the stock or ETF that you want to trade is trading at $250. So this means you need to have $25,000 to trade one contract. And so with $100,000, this means you can trade 4 contracts. So this is what I personally do, and I think it's a great way to get started. And again, there's literally an infinite number of ways of actually executing the strategy, but this is what I personally do. So let's say I trade 45 days to expiration. Contract number 1 goes from 0 all the way to 45 days and then expires worthless. And then because I have 4 contracts, basically I want to ladder it in a way that I am not overlapping all 4 at the same time for the same period of time. So then that means I would initiate contract 2 kind of over here. So it goes a little bit further than contract 1's expiration date. Then I'd initiate contract 3 kind of over here. So it goes just a little bit further than the expiration date right here. Similarly, contract 4 go just a little bit further. So then it expires right here. And this is time. All right, so that's what this yellow line is. This is time. So that means when I execute contract number 1, this is the only thing that's open. When I issue contract 2, that means both contract 1 and 2 are open. 3, all 3 of them are open. And then 4, just all 4 are open. But then look at this right here. Contract 1 expires, contract 2 expires, contract 3 expires, contract 4 expires. Assuming we don't get assigned, we still have the 4 contracts here, and we generated a bunch of cash just doing the strategy right here. What I'd personally do is ladder, and this really depends on how much capital you have. If you only have enough capital for 1 contract, then all this laddering is kind of pointless, as in like it doesn't really matter because you only trade anyways. So I'd recommend just start with owning 100 shares and then selling a call option. And with this call option, I do a 15 delta, 45 days to expiration. So this means if the stock actually gets called away from you and you have to sell the stock, then you can go ahead and then sell a put option at a strike price that you're able to. Again, this laddering is only for if you're doing more than 1 contract. If you don't really have more than 1 contract, then I'd recommend doing either a covered call or a cash secured put, and it really doesn't matter because you don't have enough capital to really ladder it. But again, this is the theory. You can do however you'd like to execute this. This way your money is still working for you kind of on an ongoing basis, so that way if the market goes down, not all of your short puts are going to get assigned at the same time. Only a little bit will get assigned. And so let's talk about it. So let's say this is the stock price and this is the time. So let's say the stock is going up. You can sell the first put option right here. And then if it continues going up some more, you can sell another put option right here. Then you sell a put option below the stock price. And then if it continues going up, you sell a put option right here below the highs. And this should be time. The reason why we do this is if you want to sell a put option right over here, that means you're going to be utilizing all 100K all at this price, rather than diversification over here, over here, over here. No matter what happens, this way it's consistently producing income, right? You basically take this 100K and you divide into 4 different parts. Now, each one is making money kind of independent of the others. I know independent with an asterisk is not really fully independent, but it does give you a little bit more diversification through this element of time, which I think is important. So a good template for you to start at is figure out the days to expiration that you want to trade and divide it by the number of maximum contracts. So for example, if we're doing 45 days to expiration, and with our example, we can trade 4 contracts maximum, this comes down to 11.25. So what this means is every 11 days, make a trade. Again, this isn't really science, it's more of an art. You can adjust this number to whatever you'd like. You can adjust this number to whatever you're able to. I mean, based on the underlying. So mostly it just comes to adjusting this, because if you can only do 4 contracts, there's really not much you can do right here. But you can change the 45 days to maybe 30. So let's say you did actually change this to 30 days to expiration divided by 4. That comes to trading every 7.5 days. So the 7.5 days just means you're going to be trading more frequently. And this can be a good thing if you are right on the direction of the market, but could also be a bad thing as when it comes to hedging. So this, you can do with this whatever you want. Again, it's a sliding scale. And so based on changing this number, you can get a drastically different entry number basically on how frequently you should trade. So if you want to change this to 45 days, you're trading every 11 days, which is significantly different than 7.5 days. So again, it's a sliding scale. You decide what you want to do. I personally like keeping it at 45 days to expiration, but based on what's happening in the markets or based on my own personal opinions, I may change it to 30 or 25 or whichever number works for me. It's really important to know again that this is just art. This 7.5 days does not mean you have to wait 7 days and trade exactly at noon just because that's a half day. No, this is kind of a good ballpark, so you kind of have a good idea of when you should trade and just maybe once a week. All this means is that every Monday morning at 10 a.m., you're going to make a trade and you just block off your calendar for 5 minutes to do that. Again, this is very subjective and something you could definitely manipulate, something that you can change based on your lifestyle and your preferences. Awesome. Well, I'll see you in the next video.